G'day mate, thanks for the comment. So let's talk about this. Share markets are going to collapse by 50% that will make the GFC look like a picnic. You're 100% right. This always happens in the share market. But should this be something that we fear? Should this be something that forces us to sit on the sidelines? Well, history says no. And I'm going to show you what's happened throughout history because as Winston Churchill famously said, those who fail to learn from history are bound to repeat it. So what we understand is that in the history of the share market, there have been typically a correction in the market 1 out of every 4 years. Now, looking at it at a simple maths perspective, if 1 out of every 4 years is a negative year, what's happening in the other 3 years? Well, the stock market is going up. However, there have been time periods throughout history where there has been a substantial correction in the market above and beyond 20%. I'm going to flip the camera around. I'm going to show you those time periods. And I'm also going to show you what's happened in terms of the recovery afterwards. So what we've got here is a history of market declines, and what we see is what has happened throughout history. So we have a look at the Great Depression. The market downturn was about 86%. We found that in the 1 year after, it went up 123%. In the 5 years after, it went up 265%. And in the 10 years preceding that, it went up 86%. We then see the post-World War II recession, negative 29%. Next 12 months was 19%. The 5 years, 71%, and then 242% in the 10 years following. We see the Arab oil embargo of 73, negative 48%, then up 38% the 12 months after, up 76% 5 years, and 161% 10 years. We see the recession of the 80s, negative 27%, and as you can see, the trend continues, right? Even to the point that we see the global financial crisis. So, the global financial crisis has been one of the the second most significant financial event since the Great Depression. We saw negative 56%, but we saw the 12 months preceding is 69%. We saw 5 years up 178%, and then the 10 years is 306%. Now, we've only got to look at history to see that we are overdue for a substantial correction in the market based on history. Now, the reality is there is going to be something that happens, and that typically comes from the point where we are at all-time highs, right? Usually we've seen in the past when we've got to all-time highs, that's usually been when there's been some sort of crash. We don't know. I might look like a wizard, but I don't have a crystal ball and I don't know what the markets are going to do. But I'll show you what I am doing in respect to how I navigate these times and what we do for our clients. And ultimately what you choose to do is largely up to you. Now, what so-called smart people are going to try and do in this situation is they're going to try and time the market, right? They're going to keep money out on the sidelines, potentially going to convert all of their investments to cash, and they're going to wait for the market to hit the bottom. Now, there is a behavioral phenomena that is referred to as loss aversion bias, which means that as a human being, we feel the emotion of loss twice as significantly as the emotion of gain. And what this largely means is that for most people, when that market falls, they're going to wait. They're going to wait for the so-called capitulation. They're going to say, market hasn't bottomed out yet. I'm just going to wait a little bit longer. The market's going to start to recover. Then they're going to jump back on, potentially not even jump in at all, because we've got to feel that emotion is holding us back because our money is out of the market now. Anything that we do is a perceived risk, right? And therefore, we've got to overcome that. And what we see, and I've seen this because I've helped my clients build over $2 billion in combined wealth, is that people don't. They sit on their hands and they wait far too long. And what that means is they miss the boat, because we see that after a sharp correction, there is a sharp recovery. And if you miss even a few days after that correction, you will substantially impact the quality of your overall performance. I've actually got some statistics. I'll try and find them and I'll show them to see what impact that has if you do miss the best days in the market. But let me show you this. What happens is this market cycle of emotion, right? We see that people go through this period of optimism and excitement and thrill and euphoria. And this is kind of where we are now, right? We're in this maximum point of financial risk because the market is at its highs, okay? And what we'll start to see is the market starts to taper off eventually. People go to anxiety and then denial and then fear and then depression, then panic and then capitulation. And then we get despondency and then we start to go through the cycle again, okay? And this is just human behavior. Markets are driven by human behavior primarily. Now, I've got a little bit of a case study here that we've done, and we're looking at 5 potential futures, right? Let's assume that you put in $20,000 a year for 20 years into a particular investment, okay? And the option could be one of these 5 outcomes, okay? You could be Patricia Perfect, where you smash the market, right? You get at the exact bottom of the market each and every single year. You're Action Jackson. Let's say that you choose to invest on the 15th of January every single year, and you just take action, right? Then thirdly, your monthly Michael. You drip feed that money in through dollar cost averaging. You split that 2,000 into monthly investments, let's call it 180, and you put that into the market each and every single month. Let's say you're John wrong. You get the very top of the market every year. You get it completely wrong. Or you're Freddie Fence-Setter. You keep your money sitting in cash. Now, here's the reality over 20 years, right? If you get your timing perfect, then sure, you're going to do best, right? But the interesting thing here, guys, is the difference between investing immediately, dollar cost averaging, and bad timing is insignificant. We're talking between 135,000 at the best scenario, invest immediately, or we've got 121,000 for bad timing. Compared to staying in cash, this is the opportunity cost of taking regular repeated action. Now, this shows you the impact of missing the best days in the market. So let's say we invested $10,000 in the S&P 500 from January 2003 to December 2022, okay? If we were invested all of the days, we would have nearly 65,000. If we missed 7 of the 10 best days that took place, we would reduce that down to 29,000, more than half cut. If we missed the 20 best days, it would be down to 17,000. If we missed the 30 best days, we would be down at 11,000. And in 2020, the second best day happened immediately after the second worst day. If we missed the 40 best days, you'd be down to 8,000. The 50 best days, 5,700. And then 60 best days, we would be at 4,200, right? 93% lower. This is why you can't time markets, guys, because even the pros get it wrong. So what do I do personally is that I dollar cost average. I keep fully invested. I know the market is going to correct. I keep capital aside, waiting for those corrections a little bit. I don't bank on them. But when there are opportunities, when the market's on sale, I buy. Because if the market falls by 50%, I can acquire the market at a 50% discount. And I continue to dollar cost average unemotionally and objectively through every single time period in the market, whether the market is up, down, or sideways. Because those who try to time the market often end up trying to catch a falling knife. They get themselves into hot water, or they sit on the sidelines and they end up doing more harm than the market ever could. Hope this makes sense. Any questions? Let me know in the comments.